Marc Faber joins in to talk about where he sees markets headed, all asset classes actually. Marc, good morning. Thanks very much for joining in. What did you read first of the kind of reaction global equities had to the Euro summit and the kind of notes that came in from there?
Well, I think markets were oversold to start with, especially in Europe, and so when there was moderate good news, there was a lot of European short covering, and a lot of stocks rebounded by 5 to 7% in just one day.
In that sense, would you say the rally is probably short-lived and saw the best part of it play out by last week itself?
Well, this is too early to tell. Basically, we made a low in early June and at 1261 on the S&P, and then we rallied and we came down again, but we didn't test a new low. And I think we may rebound to around 1400 on the S&P. That's possible, because don't forget, the month of July is a month of seasonal strength, and as we're coming into the election, there may be some more money printing and fiddling with statistics and so forth. So I think the market may actually rally a bit more. But it doesn't change the global picture, which is essentially for a global economic slowdown, for an increasing number of companies that are reporting disappointing sales or forecasts or earnings. And when there is a minor disappointment, just as was the case, say, on Friday in the case of Nike, the stock then drops very significantly and erases essentially all the gains of the last 3 or 6 months. So I think we're still in a high-risk environment, and eventually I think that in the next 12 months you will be able to buy most markets at a lower level than today. The only stocks I bought in the last 10 days are some depressed issues in Portugal, Spain, Italy and France.
How heartened were you by the comments that were made at the Euro summit though, Marc, either in terms of working towards a banking union, the vague indication of looking at Euro bonds as an option? Do you think some significant ground has been covered, or was it a mission statement that would probably not hold true for very long, at least in terms of solving the Euro crisis?
I think the details will have to be worked out, and that will take a long time in my view. So it's not, a solution that immediately will be applied and successful.
You track the euro dollar in great detail as well. Would you say things or dynamics have changed for both those currencies, and the second half may yield more weakness for the dollar, or do you think any strength on the euro is short-lived and should be approached with a shorting stance?
In my view, the euro is not a very desirable currency, but the US dollar is not much better. I think if you look at the action of central banks around the world, it is very difficult to find any paper currency with which you can be particularly happy. And if the Chinese economy slows down more, as I expect it will, then you will also have easing in China and capital flight, and maybe the Chinese RMB will weaken. So among the contest of who is the least ugly currency, I would say probably the US dollar for the time being. But that doesn't change the fact that the US dollar was overbought recently, and sentiment surrounding both European stocks and the euro was extremely, and I repeat, extremely negative. So I think a rebound in the euro may continue for a while, and then we'll have renewed weakness in my view.
Just to step away from this recent news flow for a second though, Marc, it's been a 5-year bear trend almost for markets. How would you call the second half of this year going into next year? Do you see anything that marks an end for the bear rally or a troughing out of markets, or do you think we're in for a longer haul here?
Well, we have to be very specific. The total return of equities if you include dividends since 2007, hasn't been a disaster. It hasn't been particularly good, but it hasn't been a disaster. And the return from bonds has been very good, and for commodities, depending which ones you owned, was also reasonable. So I think for investors, actually, the situation was not all that bad. But I concede that a lot of people lost a lot of money because they were badly positioned, either overweight stocks that went down a lot, or they were, in the case of the US, heavily geared into the property market that tumbled and so forth. So I agree that it hasn't been a particularly happy time for investors.
Pleasure speaking with you, Marc. Thanks very much for joining in with your thoughts today. That's Marc Faber saying approach with caution. There have been some placatory noises made from the Euro Summit, but it doesn't seem like a solution is completely out there. We leave the